but above all, one that in the short term can create either an upwards pressure on property price movements or downwards pressure.
With the Reserve Bank increasing interest rates again, there's all sorts of bad media about bad news in the property prices. What's actually going to influence property prices going forward? Today, we've got special guest Louis Strain to help us through breaking down the two major factors that influence property prices. Louis, welcome to the show.
So when it comes to property price movements, the two things that matter more than anything is supply and demand. It's the natural factor of price movements where if you've got a high supply, low demand, prices will come down. But when breaking these factors down further, on demand side, you've got things like population growth, wage growth, as well as individual demand for properties like their proximity to the CBD, the desirability of the suburb, whether it's close to school, transports, and the like. On the supply side, you've got things like land availability or the number of new properties being completed, as well as people selling en masse. If everyone's selling property, the amount of supply is increasing.
It's a relationship there between the two that you kind of need to get right. That's really, it's not one of those things. And I guess that's where the media gets it wrong, where they're like, well, there's this huge, lots of demand. Well, no one wants to buy anymore because rates are going up. It's not that simple, right?
100%. Because overall, when it comes to property price movement, even recently, the weather has been a massive influencing factor where in Queensland, we had major floods that knocked a lot of properties out. It also stopped the amount of new constructions going on because there was constant rain slowing down that factor. So there's millions of different things that can influence property, but above all, one that in the short term can create either an upwards pressure on property price movements or downwards pressure is actually credit growth. And that's what everyone's talking about at the moment, because you've got the RBA increasing interest rates, and that's slowing down how much people are actually borrowing. And historically, when you look at Australian property prices, the major factor in the short term has actually come down to credit growth, because out of all the other factors, things like population growth or wage growth, and even on the supply side, these do all have natural caps on how they grow. Because wage growth, it's not like all of a sudden, one quarter it goes up by 20% and another quarter can go down 20%. Same with population growth. But wage growth overall has been pretty consistent over the past 20, 30 years. However, property prices haven't. You've seen boom bust periods. And a lot of that has been correlated to not only interest rates being controlled by the RBA, but from APRA as well, which is the entity that controls banks' lending regulation.
As an individual, like let's break that down a bit further on how that looks practically, like just credit growth. I guess, what does that actually mean?
Credit growth, how it's measured is basically showing people how the increased levels of borrowing is being translated into the market. So when credit growth is up, it actually means that the amount people are borrowing has also gone up. And that could be either you've got more people borrowing the same amount, or it could simply be you've got the same number of people, they're simply just borrowing more. But regardless of that, if there's more money being borrowed and that's directly being translated into buying property, it actually can affect the price quite dramatically. Because remember, property is a competitive market. If you and I are both competing for the same property, but you can borrow an extra $100,000 than me, well, it's highly likely that you're going to be the winner of bidding at an auction for that property. And that is a very simple example. But if you have, say, 100 people all interested in the same property, and one of these individuals just wants it more, hence there's a high demand for them, well, it doesn't matter how much they want the property. It matters how much they can actually bid for the property, which again, most times comes back to borrowing capacity. So if borrowing capacities are going up, you've got additional credit growth, and therefore you've got increasing property prices overall.
That further, like as far as the underlying conditions which sort of increase and reduce the amount people can borrow. So you said there's obviously borrowing capacity, which is sort of influenced by the Reserve Bank and cash rates and that sort of thing. The second factor there, as far as APRA, do you want to sort of break down what they do and have done previously to restrict some of this?
APRA is the entity that regulates deposit-taking institutions, or ADIs for short. These institutions are banks, and the way that the banks lend over time has changed quite dramatically. It used to work under a fractional banking reserve system where the bank could only lend based around a deposit ratio of 10%. So if someone deposited $1, they would then lend approximately $10. However, that all changed in the early 90s, where what's known as a capital adequacy requirement replaced it. And the banks technically don't need your deposits anymore because they can issue things like tier one capital in themselves through reserve notes, as well as basically hybrid securities. And that's what a lot of banknotes, like CBA's had their pearls over time, have actually gone towards in building up their tier one capital. So this increased the amount the banks could lend, where they no longer required depositors, where if depositors weren't saving money, the banks were limited on how much they could lend. And that had a dramatic impact on property prices, where all of a sudden, the amount of property growth was starting to be seen to be correlated to credit growth, where previously from, say, the 1970s to 1990s, overall growth over those couple of decades was annualized at about 1 to 2%. And that was pretty consistent with the overall increase in savings. And when the floodgates got opened, you started to see more volatility within the property market that got tied back into lending standards and also interest rates.
I saw that as well, I guess, in recent memory around the Banking Royal Commission in 2017, where the banks were starting to get into, I guess, a bit of trouble with, well, there was a spotlight put on, I guess, some of banking practices where they weren't putting any buffers for sort of future interest rate hikes. They sort of wound in some restrictions for investor lending. They kind of put in like an extra buffer if you're buying investment property compared to an owner-occupied property. And I suppose we saw the change in the lending market directly have an impact on property prices, right, at that point?
Yeah, correct. In 2017, the Banking Commission went through and APRA was forced in a way to start increasing the amount of scrutiny on bank lending practices, where previously they didn't really do too much of a deep dive into your spending habits. Now all of a sudden they had to quite go through all your mortgage statements, if you already had a mortgage, as well as credit card statements and how much you were spending. They also, as you said, changed the requirements for investor lending and interest-only loans, where the interest rates were increased for those. When going back to 2013, I had an interest-only loan and it was the same interest rate as what a principal and interest loan was, but now you're paying half to a full percent more for that. That declined the credit growth in that sector, and it actually translated into lowering property prices between about 2017 and 2018.
Yeah, and I guess like fast forwarding to today, and I guess what this can do in the future, definitely we've seen some changes. So like one thing we've noticed is that the increase in interest rates hasn't actually directly impacted borrowers as much, because the banks have done some stuff in the background where, so for example, when you would have got a loan, when you got your loan in 2017, the banks were giving you like a 0.7% discount off their standard variable rate. So if their variable rate was 6%, they're giving you, 5.3%, and life goes on. These days, they're giving you a 2% discount off the standard variable rate. So it just means that your borrowing capacity hasn't been reduced as much as some of these interest rate rises. And even some of the, I guess, critiques that happened in the Royal Commission around, so the living expenses, like you said before, there was the famous sort of Shiraz and Wagyu case against Westpac where, the judge said, basically, it's actually reasonable for someone to be dining on Shiraz and Wagyu one day and potentially have to pull up their socks the next day to be able to afford their home loan. So where, like you said, the banks were forensically going through statements, and in some cases, some banks still do this today. In a lot of cases, they're happy to say, well, you know what, Louis, like we know you were spending too much last week. Next week, if you got to pull your socks up for your home loan, we're okay with that. So we have seen like a bit of ebb and flowing, with some of the way the banks are assessing things now. And it's not been as sort of hardline. It's not been as directly as correlated as, the interest rate's gone up by 1%, your borrowing capacity's come off by 5% sort of thing.
Yeah, 100%. So it all comes down again just to borrowing capacity, and that's what banks are willing to lend. And the biggest influencing factors of that are typically interest rates. But if the banks do accommodate the overall borrowing capacity of individuals, it doesn't mean that it actually translates directly into a massive drop or credit growth falling off the cliff. And there have been times in the past where the RBA has dropped interest rates, and again, APRA has come to the table and started to increase the amount of borrowing capacity. And it's actually translated into lowering property prices. So again, property has in the past gone down, and there have been a number of times when looking at the property market, it's been pretty much in a constant boom for 22 years, since about the 2000s, where prices have gone up collectively about 160%. Again, some areas have gone up much more, some areas haven't gone up by as much, but just looking at the aggregate of Australian property prices, it's been annualized at about a 10% growth rate. But there's actually been 5 times in that time period that property prices have declined. In 2008, they went down. Between 2010, 2011, they've gone down. In 2015, then between 2017 and 2019. And there was also a small decline at the start of the pandemic in 2020. And during all these time periods, it was again correlated to changes not only in APRA standards, but also increasing interest rates.
Which is an interesting point, because I guess that's the thing that people forget, and especially over modern history, coming into COVID, even in 2019, when APRA actually put in some further regulatory changes where they made the banks put a sort of a minimum floor of 7% on sort of their assessment rates. A lot of punters were coming out and saying, like, the property market's going to drop, things are going to drop. COVID happened, they were saying it's going to drop, and went the other way. Now it's the same sort of situation. But I guess to your point, property market, it can't always go up. The cash rate was at sort of emergency setting levels. The market was growing between 20 to 30% a year. It's just not sustainable. So it's sort of worth looking at some of those, taking that view. And I guess it's kind of like, with what you do, Louis, looking at sort of the stock market, looking at, even, funds and that sort of stuff. It's impossible for things to go up all the time, right? Like, it's just not sustainable. It's just not going to happen. What sort of view do you take, I guess, with investing or property market in general?
My view is often very boring. It's for long-term stable returns. And when it comes to, I guess we'll go through residential side first. If you're purchasing a property residentially to live in, and the aim is to flip it in the short term and make a massive profit, it's not a thing that can always work in your favor. And again, all comes back to unknowns in the future. If all else being equal and interest rates keep going up and they hit, say, a standard variable rate of 6%, that's where the property price index is estimated to drop about 10 to 20%. However, as we've seen in the past, APRA can often step in and tell banks that they need to try to increase credit growth, as well as the federal government entering property sectors and actually increasing incentives, say the first homeowner building schemes, as well as even recently that $25,000 building grant. A lot of that can influence that drop and actually see not much of a decline if the federal government starts to see property prices going down. But for an investment perspective, the main thing for investments is seeing long-term capital growth. And it's been the case with shares, I see particularly, because they're very liquid assets. People often can get in and out of them very quickly. Property, not so much, because it's much more liquid. You've got to put it on the market, which can often take a few months to sell. Then you've got settlement dates. But with the share, you can simply click a button, sell it within an instant, as well as purchase it. So that's why the share market's quite more volatile than the property market. But when it comes to flows, when it comes to share funds in particular, ETFs, managed funds, as an instance, those have over the past 25 years, even though the managed fund or index fund or ETF might have had a great long-term return, the average investor in those funds has actually lost money. And that's because they're trying to chase returns. They see a fund go up 20, 30% in a year, and then they buy once it's gone up quite massively because they don't want to miss out on that return. And then all of a sudden, the fund goes down and they sell. So the Dolbar's done a bit of study on behavioral investments from individuals and found that the average investor is not great at timing the market. That's why I don't think short-term flipping of any assets, if done consistently, can work in your favor. Some people get very lucky and do it well, and that's great. But when looking at average numbers over time, it is very hard to manage. And that's where if you are buying an investment, if you buy at today's price and you wait 20, 30 years, well, you'll likely see some good capital appreciation. But if you're buying an investment today to try and flip it next year or in 2 years' time, you are running the risk at not being able to actually see any capital off that transaction.
In summary, like it sounds like there's obviously lots and lots and lots and lots of factors that influence the property prices. Credit growth has been a major one over the last few years, but equally the government and APRA can change that if things aren't going the sort of right way. And even in some parts of the country, we've already seen that sort of 10% off in Sydney, in Melbourne in particular. In the other states, it hasn't obviously filtered through. So I guess to your point earlier, property is super specific. It's suburb specific in some areas, even for the city. So it's worth trying not to generalize too much there.
So as you said, this has been a very generalized conversation. It's looking at the aggregate markets for property as well as credit growth. So we are talking about hundreds of thousands, if not millions of properties, where some will, even in this time period, not lose as much value. Some will lose more. But overall, since APRA introduced their capacities to give banks the lending that banks really just simply meet demand these days, otherwise they would actually have some natural constraints. Well, property prices have gone up, and therefore credit growth has had in the short term more of an impact than, say, population growth, because population growth is fairly consistent year on year out. Similar to wage growth, where it does have lower periods, it also has high periods, but it's not like it jumps 30, 40% within a short time period. So the biggest thing to watch out for at the moment is obviously credit growth slowing, where if it does slow quite dramatically, and some of the latest data from the ABS has showed that it has declined by about 15 to 20% compared to last quarter. But again, we're comparing the peak of the market where we're at almost all-time high credit growth, where it's more normalizing. So in the long term, looking at property over the next 10, 20 years, the thing that it comes back to is buying a place that you are still going to be holding on to over that time period and not trying to flip in the short term.
So Louis, you do a podcast. Tell us where we can find you. You're a financial advisor. You're amazing. Where can they find you?
So the podcast is financeandfury.com.au. We release an episode normally about once a week, and it covers topics exactly like we're going through today.
Awesome. Well, Louis, thanks for your time. That was amazing.